Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening. Tonight's webinar is going to specifically cover real estate investing in your self-directed IRA. I do want to mention a few things before we get started. STC is a retirement plan administrator only, so we do not provide our clients with legal, tax, or investment advice. We also don't represent any particular investment. We don't sell securities. We're not a registered investment advisor. We don't represent nor do we endorse any particular investment opportunities. And I will be talking about some real estate opportunities in this webinar, but we don't represent or endorse any of them. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to focus on, first off, just some basic information about self-directed retirement accounts, the benefits of self-directing, guidelines that must be followed in all retirement account investing. I'm going to go through the services that STC offers, and then we're going to go to real estate investing, choosing and funding an investment, purchasing real estate. We're going to talk a little bit about non-recourse loans and UBIT. Those topics can apply to real estate investing in a retirement account, and then I will open the floor for your questions. So let's get started first with a definition. What do we mean when we use that terminology, self-directed retirement plan? And what we mean by that definition is that you are working with an entity, a company, that permits you to choose any type of asset that is allowed by the law. So that would include what some consider non-traditional assets, like real estate. Self-direction also means that you manage your plan's retirement investments. You're going to make the decisions that are related to those investments. So basically, you have direct control over the investments in your retirement account when it's a self-directed investment. Now, there are a number of different types of retirement plans, and I brought out onto your screen two, traditional IRA and Roth IRA. These are similar in that they have identical maximum annual contribution allowances. For 2023, you can contribute into either of these accounts $6,500 from your earned income. If you are 50 years or older, you can add a catch-up contribution of $1,000 to make it a total of $7,500 if you wish, up to that amount. The difference between these two plans is significant. When you make a contribution to a traditional IRA, like most retirement contributions, it is pre-tax. In other words, you will take that amount out of your taxable income that year, and instead, when you begin taking qualified distributions after reaching retirement age, then you will include those distributions in your taxable income. A Roth is different. When you make a contribution to a Roth IRA, it is post-tax, meaning you pay taxes on that $7,500 if you contribute the maximum. However, when you begin taking distributions, the distributions that are qualified after age 59 and a half, and you've had the account open at least 60 months, 5 years, then those distributions are not included in your taxable income. So what that means, in a Roth account, you make your contributions that you've paid tax on, but then hopefully you are earning money on these contributions through your investing efforts. So all of these earnings inside this Roth account can be tax-free if you're taking them in a qualified distribution. So a Roth IRA does provide an opportunity for some tax-free earnings. That's a big difference. The next plan I have is a STEP. Excuse me. This is a simplified employee pension plan. And this is sometimes used by sole proprietors or small business owners. You can make an employer and an employee contribution to a SEP. It has a higher amount that you can contribute because a SEP is on a business. And that amount for 2023 is $66,000 from the earnings of the business. A simple plan, savings incentive match plan, another type of plan that I've seen some partners use, again, some sole proprietors use. Pardon me. And its maximum contribution for 2023 is $15,500. Now, I'm bringing out onto the screen 4 different plans that all say former employer. A 401k is a corporate type retirement plan. 403b, often used by charitable organizations or nonprofits. A TSA is a tax-sheltered annuity, and a TSP is a thrift savings plan. Now, if you formerly worked for an employer and participated in one of these plans, then you can move the money out of that plan into a plan that you qualify, say a traditional IRA. And then if you wanted to self-direct, you could from that. If you are still employed and participating in one of these plans, then you will need to go to your plan administrator and ask if you are eligible to move any money out into another type of plan if you would like to do some self-direction with some of those monies. But you will need to see your plan administrator. A solo 401k, sometimes it's called a uni 401k. This isn't, well, it's not new now, but it is a newer type of plan that was really designed for sole proprietors, people in business for themselves, by themselves. So it can be an incorporated business, or it can be a Schedule C type of situation where you're a sole proprietor. But you can take out a solo 401k on your business. It has some nice advantages in that you can make both employer and employee contributions. You can have a Roth provision in your solo 401k, so you have that tax-free earning possibility in the Roth portion. It does also have a loan provision available as a small business owner, sometimes being able to take a loan from your retirement plan. And the loan can be for any purpose. Actually, it doesn't even have to be for business purposes. As long as it is paid back according to the terms with the interest, you can take a loan in a solo 401k. Only one stipulation: if you are opening a new solo 401k, you do need to have that open by December 31st in order to make contributions for that year. So if you had a business, wanted to start a solo 401k and make contributions from your earnings in 2023, you would have to have that plan completed and opened by December 31st. So just a little bit about some different types of plans. Now, I do want to discuss briefly why you might be interested in self-direction. What are the benefits? And probably one of the biggest one, and a major reason that many people choose self-directing some of their retirement assets, is that they can diversify into asset types that might not be permitted if you're, say, with a bank company or an investment company. You can invest in things like real estate, mortgages, notes, private businesses, precious metals. Sometimes banks will not hold those types of assets for you in a retirement account. So it does permit you to truly diversify into a wide variety of types of assets. Again, I've already mentioned that you're choosing and you're controlling the investments and the transactions that you make. If you are interested in a real estate transaction, you can actually increase the buying power of the money that you have in your account by using leverage. In other words, your retirement account can get a loan to purchase a piece of real estate in your retirement account. So you can use other people's money to partially fund this investment. And because of all of these things, you may be able to experience a higher return on your investments by self-directing. Now, there are guidelines for all retirement account investing, not just self-directed, that must be followed. There are administrative requirements that have to be fulfilled. So every year, an annual valuation of your retirement account must be made. An annual report is submitted to the IRS. It's Form 5498. Books and records in detail of all of your transactions, earnings, expenses must be maintained. Sometimes state filings are required depending on what you own and where you own it. and on occasion, tax returns could be required. That is pretty limited, and it does come into play with UBIT and UDFI, which I am going to discuss in a few moments. So these are all guidelines, administrative requirements that must be followed for a retirement account. In addition, there are some kinds of things that you cannot own and transactions that you cannot do that are prohibited. So prohibited assets are life insurance contracts, with an exception. If it is a solo 401k plan, life insurance contracts are permitted, but otherwise they are not. Another prohibited asset type are collectibles. So art, works of art, stamp collections, coin collections, rugs. Now, this does not include precious metals. Precious metals have been defined, what can be owned in a retirement account, and I can discuss that if someone has a question about that. But we're talking about collections, rare coin collection, that kind of thing. Those kind of collectibles are not permitted in a retirement account. And prohibited transactions. Transactions need to be for the benefit of growing your retirement account. So it does need to be a transaction you're engaging in hopes of making money for your retirement account. You cannot personally borrow from your retirement plan. You also cannot pledge your retirement plan assets as security for a personal loan. That is prohibited. You also cannot use your personal credit or guarantee to obtain a loan for the retirement plan. So you remember I mentioned that your retirement plan can get a loan, but you can't personally guarantee it. It does need to be a particular type of loan. And you also cannot benefit any disqualified person with a transaction that your retirement account engages in. So let's just take a quick look at who disqualified persons are. And you'll see the first one is you. You and your retirement account are separate and distinct entities. So your retirement account cannot do a direct transaction with you. And if you are married, this includes your spouse. So for example, let's say you own a vacation rental property in Myrtle Beach, South Carolina. Your retirement plan cannot purchase it from you. And if your retirement plan owned it, it can't sell it to you either. So you are a disqualified person to your retirement plan. There are other family members who are also disqualified besides your spouse. Your ascendants, so that's parents, grandparents, great-grandparents, on up the line. Your descendants, children, grandchildren, great-grandchildren, on down the line. All those lineal descendants and ascendants are disqualified people. However, lateral family members are not disqualified. So that's brothers and sisters, aunts and uncles, nieces and nephews, cousins. None of those family members are disqualified. So back to that vacation rental property at the beach. If your father owned it, your retirement account could not purchase it from him. If your daughter owned it, your retirement account could not purchase it from her. However, if your brother or your aunt or your third cousin owned it, your retirement account could purchase it from them. So just to help you keep in mind that there are certain people that your retirement account cannot do direct transactions with. I am going to talk a little bit more about a way that you can actually partner with those as opposed to a direct transaction. There are also two companies that are disqualified persons to your retirement account. Any company, if you're a majority shareholder, so that doesn't necessarily mean 51%. If there are more than two shareholders, let's say there are three, if you own more than 33 1/3%, you're the majority shareholder. So that company would be a disqualified person to your retirement account. Also, any company, if you are an officer, a director, or a highly compensated employee. And during this webinar, I do often have real estate investors on this particular webinar. And oftentimes They are running their real estate investing business through a company, could be an LLC, could be an S Corp, whatever. That company, if they are the majority shareholder or an officer, director, HCE, that company is a disqualified person to their retirement account. So something to keep in mind when you're thinking about structuring transactions. I do want to talk about STC's full service approach. This is what we do. This is all we do. We are a self-directed retirement account administrator. So what we do is we set up a retirement account LLC structure for each of our clients' accounts, and I'm going to explain why we do that and why that's important to you. We also have CPAs and attorneys available to answer any very technical questions about your retirement account investing. We offer unlimited guidance on transaction compliance. We have a wonderful client services department that's available to help assist you with this. We handle all of that administrative back office support that I mentioned earlier. We will maintain LLC financial statements with all of the details of your transactions, earnings, expenses, sales, purchases, distributions, contributions, all of those things. We'll maintain those on your financial statements that you have access to. And we will supervise the regulatory reporting that is required, and we will oversee the annual valuation. So basically, our goal is to provide you all of the administrative and expertise in investing and guidance that you need so that you can really focus your efforts on finding the best investments for your retirement account. Now, I said that we create an LLC. We use an LLC structure for each of our clients' accounts, and we do this for a number of reasons. One being that it does give you a great deal of flexibility in structuring complex transactions. So you could potentially have a transaction where you have multiple parties. Maybe you are co-owning the investment. Your retirement account is not the sole owner. Perhaps you're co-owning and you're getting a loan. Perhaps on this real estate property, you're going to be doing some work and you might be hiring a contractor to do that work. So having an LLC structure gives you flexibility in structuring these complex kinds of transactions. Now, it does also give you an additional layer of asset protection because it is a limited liability company, albeit a very specialized one. It is written, it's designed to be owned by a retirement account. So it is a specialized one. This LLC structure also gives you checkbook control over your retirement account funds. So this means that you have fast response to investment opportunities. Now, I have checkbook control in quotes because we don't actually give our clients the checkbook. Just in case you are not extremely well versed in the rules, you could potentially engage in a prohibited transaction. So rather than do that, what we do is we have you send us the documentation, fax it, email it. We review it immediately. If it all looks good and there are no questions, then we can same day or next business day fund that transaction. So basically, you have protected checkbook control. You have the protection of our expertise looking over that transaction before it's funded. Using the structure also simplifies asset titling. Again, for a real estate purchase, you can actually go to closing on behalf of your retirement account and sign the documents on behalf of your retirement account. You don't have to send them to our office where they sit on somebody's desk who maybe is out for vacation this week and wait till they get back to have a look and sign off on them. No, that's not how this works for us. You can go to closing. So that makes it much simpler. It does also make pooling your retirement account money with other sources of funds to co-own an investment. And we'll talk a little bit more about what that might look like. But your retirement account does not have to fully fund an investment to participate in an investment. Now, there are many investments that you can choose from in a self-directed account. The first ones on this list are real estate, single and multifamily homes, vacation property, raw land, building lots, commercial buildings, real estate syndications, tax liens. It's not exactly a real estate investment, but it's kind of related to real estate. And by the way, tax liens are foreclosable. So if the lien wasn't repaid, your retirement account could actually own the property, could foreclose on it. Mortgages, loans, private business investments, operating businesses, and as I mentioned, precious metals. And of course, you can also invest in the Forex market, options, futures, and stocks, bonds, and mutual funds. So you really have a wide range of asset types that you can invest in a self-directed account. Now, just to give you kind of the brief outline of how investing your funds works with STC, this first step is optional, but I highly recommend it. You request review of your transaction and its structure in advance. Our client services department are happy to look over your documentation, who you're buying from, what you're buying, where you're buying it, how you're paying for it, all those things, to make sure that all of the documents are titled properly. So you can do that as much as you need to, and we can give you guidance to make sure your transaction is in compliance. And then you will request transfer of funds. We actually have a form that you will fill out. Tells us who you're buying it from, where to send the money, any supporting documents that are necessary for the transaction. Then you send that to client services. Again, fax, email. You can actually mail it, but don't really recommend that. Client services is going to review that transaction as soon as they get it. They will then, assuming everything is fine because you've had them look at it in advance, they will process the transfer request, and then funds will be sent from the bank that your LLC account has access to, from that bank to the seller. So it doesn't go through you, it goes direct from your LLC bank account to the seller. And now you own that asset in your retirement account. And we can give you 24-hour turnaround. If we have your documentation and everything is all lined up by 2 p.m. Eastern time, we can same day fund that transaction. If it's after 2 p.m., that's the bank cutoff, then it would be next business day. But we can get that done for you very quickly. Now, let's specifically talk about purchasing real estate. Now, it's your job as a retirement account owner to find your best investment. So for you to locate the property that you want your retirement account to purchase and to make an offer on that property. And we can't really provide any recommendations, and we can't tell you if it's a good investment or not. We can't give you any rental or resale guidance. That is outside of our purview. So it's up to you to find the property and make an offer. Now, that offer must be in the name of the buyer. In this case, it's your IRA LLC. So if you're not partnering or pooling with another funding source, then that's the only name that can be on the offer. Can't be yours personally and your retirement account, just your retirement account. Now, if you are contributing some money to this purchase, and that is a possibility that I'll show you on a future slide, then both your names would need to be on this offer, your personal name and the IRA LLC name. So our client services department can help you make sure you have this titled properly. Now, if you need an escrow deposit, and pretty much everybody does, then we will need a copy of the contract that shows the IRA LLC as buyer, who the buyer is, and we'll also want a completed document that we use. It's called a request to transfer funds form, and we'll need that. And if you're going to closing, we'll also need a copy of the estimated HUD or settlement statement, at least one day, and that has to show the IRA LLC as buyer. And we also need a completed signed request to transfer funds form. So this is, the first was for the escrow deposit. Now this is for the closing funds. We do ask that you get that to us at least one business day before closing. You know, if there are any questions, We want to be able to discuss that with you. Really give us as much time as you can before the day you're going to go to closing. And typically the disbursement of these funds must be guaranteed. So you'll probably request a wire transfer. That's what most people are doing these days. Now, again, one of the benefits of the IRA LLC is that you go to the settlement table and you sign all the closing documents. And we'll discuss this transaction with you. Make sure that you're not dealing with any disqualified parties, you're not using any prohibited funds, you've got the right name and the titles. But we do not need to approve and sign the documents, which is required by many custodians when the LLC structure isn't used. So you can go to that closing. Now, you do have the option again of using borrowed funds. However, it does need to be in the form of a non-recourse loan. UBIT will come into play. I'll discuss that if you use a non-recourse loan, and that's going to apply. Well, I'll tell you that later. Now, you will send a copy of the closing documents to us, and you can keep the originals. As I mentioned, if you do use borrowed funds, it must be a non-recourse loan, and UBIT, unrelated business income tax, a subset of which is unrelated debt financed income, will come into play if you are using a non-recourse loan. Now, back to this situation, you can partner with anyone, including disqualified persons, at the inception of the purchase transaction. So if you partner with otherwise disqualified persons, the ownership percentage, the percentage of this transaction that each owner has, can never change during the life of the transaction. All property expenses are paid pro rata based on ownership. All property revenues are distributed pro rata based on ownership. So let's just throw out an easy example. Let's say you put down 25% of the money and your retirement account puts down 75% of the money to co-purchase this asset. You do this at the inception of the transaction. So that was 25-75. So if there's an expense on this property, you're going to pay 25% of that expense, and your retirement account is going to pay 75%. When, let's say, it's a rental property and rent is received each month, you personally are going to receive 25% of the rent, and your IRA LLC retirement account is going to receive 75%. And those percentages can never change. When the property is sold, same deal. The proceeds will be divided based on your ownership percentage. Now, you can set up a sub-LLC to own the property. So let me just describe this. You've got your IRA LLC that is owned by your retirement account. So all of your retirement assets are in this big IRA LLC. That IRA LLC could own a sub-LLC to have a single property in it. We know that some people like to do that, have each property in its own LLC. And I'm thinking it probably has to do with limiting liability. If you do that and you choose to do that, it doesn't change any of the rules. All of the rules relating to retirement accounts must still be followed. Now, in that scenario, what we would want to see is our client services department would need to see the operating agreement for that sub-LLC, who the owners are, the amount they're contributing, their percentage ownership, and we would expect their ownership percentages to match the amounts that they've invested. And that's actually a requirement if any of the owners are disqualified persons. So we can help you set this up and make sure that it's viable, and it can be done, but just know that by doing this, you can't circumvent any of the retirement account rules. It just is putting a property in its own LLC. So all of the rules still apply. Another thing to remember is that disqualified persons cannot do rehab or repairs, and they cannot be a tenant, a buyer, or a seller. So let's just say your son has a great repair business. He's a disqualified person to you, to your retirement account. So he can't do any repairs on a property that you own in your retirement account. Let's say you own a property in a college town, a rental property. You cannot rent that to your daughter because she's a disqualified person. She cannot be a tenant, can't sell it to her. So you just want to keep in mind these disqualified persons rules, and we'll help you to understand that too. Now, I talked about partnering with others to co-own an investment. I said that your retirement account does not have to be the sole owner of an investment. You can partner with others, and in fact, you can partner with yourself, your own personal money. You could partner with your spouse's retirement account, and family members, including an ascendants and descendants, as long as this partnership happens at the inception of the purchase transaction, because then basically each of these parties is doing a direct transaction with the seller and not with each other. And as long as those ownership percentages stay the same throughout the entire transaction life, that partnership is allowable. You can also partner with colleagues, LLCs, they can be incorporated, investment syndications. All of those are available for partnership and co-ownership. Now I want to talk a little bit about the retirement plan structure that I've mentioned and that we use, and give you a little schematic to help you understand it. You'll see on the upper left your current custodian. So let's say you have an account you want to move to us so that you can begin self-directing. So you would complete some documents with your current custodian that would direct them to transfer or roll over to our self-directed custodian the funds that you want to self-direct. While that's in process, our operating department is going to be setting up an LLC in the state of your choice, and they can talk with you and discuss about where and why you might want to choose a particular state. Once that LLC setup is complete and the funds have been received by our custodian, then the money is going to move to a bank that your LLC has access to, and the ownership, the membership interests of that LLC are going to be held by the custodian. So at this point, your money is now in the bank and you're ready to begin investing. And in this case, you can see that your retirement account has 3 investments. Investment number 1 is a tax lien investment, wholly owned by your retirement account. Investment number 2, you purchased a property in your retirement account to rehab and rent it. Investment 3 is interesting because you don't own that wholly in your retirement account. It has 4 owners. Investor number 1 is your father. Investor number 2 is your daughter. Investor number 3 is some of your personal money. And investor number 4 is your retirement account. So this does work even though those are otherwise disqualified persons, because you co-invested at the inception of the purchase transaction. So we have many clients who come to us who want to do just this type of transaction. Maybe they want to partner with personal money or with their spouse's retirement account, and we can help you understand how to do that correctly and make it a viable, allowable transaction. So that is how partnering works. Now, I want to spend a little bit of time and talk about non-recourse loans, because they certainly give you an opportunity to own real estate that you might not otherwise be able to fund with the money in your retirement account. So first, what is a non-recourse loan? Non-recourse simply means that the security instruments, the notes, the mortgages, they don't allow any recourse against the individual account holder, you, or any other balances in your retirement account. The only recourse to the lender, if there's a default on this loan, is the property itself. There's no other recourse. That's where that term comes from. So in the event of default or foreclosure, the property is the only source of repayment. Now, pardon me. Again, this is your retirement account that is getting this loan, not you personally. So your retirement account doesn't have a job, so there's no income or employment verification. And I'm just going to run through some industry standards for this type of loan. Of course, what you will want to do is go out and do some research into different non-recourse lenders and find out the specifics of their terms. But generally, required documentation is going to be, of course, a loan application. They're going to want to see a purchase and sale contract. They will want to see an IRA statement or whatever kind of retirement accounts you have. They'll want an appraisal of the property. If it's a rental, they're going to want to see what the rent rolls have been in the past. Loan guidelines, generally the maximum loan to value is 70% with this type of loan. So you're going to have to be able to put down at least 30% from your retirement account. Terms, we've seen 20 to 30 years terms. We have also seen adjustable rate mortgages, 3-1, 5-1, 7-1. The lender's going to be looking for an income to expense ratio probably of at least 1.25. So you'll want to take that into consideration when you're evaluating proceeds, incomes to expenditures that you expect. And another thing that they will very likely require is reserves to be held in the account, generally anywhere 3 to 6 months reserves of anticipated expenses. And let me just explain why that is, because some people wonder why they have to hold cash in the account. And it is because your retirement account owns this property. So when property taxes come up, when a windstorm damages the roof and you have to put a new roof on it, or the septic system goes out, your retirement account has to be able to make those repairs. It has to have sufficient funds in it to make repairs and pay taxes, etc. So because you are limited in the amount of money you can contribute annually into a retirement account, you can't contribute more than the law allows, the bank is going to want to see that you've got some funds in this account available in case something happens or to pay taxes, etc. So that's what those required reserves are for and why the lender will require them. Eligible and ineligible properties. Eligible, certainly single-family residence. Some condos, you would need to check with the lender. 2 to 4-plex housing, multifamily, apartments, retail, office, warehouse, all of that is eligible for non-recourse lending. Things that are ineligible, mobile homes, timeshares, condo hotels, that's a little bit of a newer thing, certain restaurants, residences with 5 or more acres, so a lot of property, and farms are generally ineligible for these types of loans. So just a little bit of information, because many real estate investors in their retirement accounts do want to be able to use loans. Now, I want to bring up this topic because it relates to having a loan. Unrelated business income tax is a tax that the IRS has set up, and it has a subset called unrelated debt financed income, which is taxable. So it's UDFI, unrelated debt financed income. So this tax applies to income that's generated from an asset that was purchased using financing inside a retirement account, in particular, is what we're discussing. UBIT can relate to other situations, but it does relate in a retirement account as well. The IRS has decided. Now, UDFI is based on the net income of the property. So right there, you want to understand that all of your income is then reduced by all of your expenses. So you're going to be taxed on the net income. The first $1,000 of that net income is exempt from taxation. And the percentage of taxable income is based on the ratio of debt on the property. Now, let me just explain what that means. Let's say, to make this easy to think about, your retirement account purchased a property for $200,000. You financed $100,000 and your retirement account paid $100,000. So that means this was 50% debt financed. So that means that only 50% of the net taxable income, only 50% of it is subject to UDFI, not the whole amount. Now, to help you understand this, and one more item. Oops. When this asset is sold, I'm sorry, I'm having a little trouble with there we go. When the asset is sold, a percentage of the gain, if there's a gain, is also subject to UDFI, unless the loan had been paid off for 12 full months prior to the sale. So generally, there will also be tax on the sale. Now, one thing I will mention here, just back to that solo 401k plan that I mentioned. In a solo 401k plan with a real estate investment using leverage, UDFI does not apply. So that's something interesting to note if you're interested in that type of plan. Let me give you a simple example to help you understand this. I have talked with folks who say, nope, I'm not going to do anything if I'm going to have to pay taxes out of my retirement plan. But you might want to really consider, how much tax would you have to pay? How much would you be earning? If you can't do the transaction, you're not earning anything. So let's have a look at this. This is an example investment where we have a rental property that's 50% debt financed, just like my example. And in this case, the annual net rental income is $12,000. Net meaning I've already deducted all of the expenses, and so about $1,000 a month. So the annual net rental income is $12,000. The income that's going to be subject to UDFI is $5,000, and here's how I calculated that. The net income was $12,000, but we said it was only 50% debt finance, so only 50% of that $12,000 is subject to UDFI. So 50% of $12,000 is $6,000. And then I said that the first $1,000 is tax exempt. So $6,000 minus that $1,000 comes up to $5,000 is how much income is taxable. Now let's look at what that tax is. For 2023, and it's always taxable at the trust tax rate. That's the rate that the IRS says applies to retirement plans. It's the trust tax rate. And the trust tax rate is a graduated rate. It's from 10 to 37%. So in this particular example, I did the calculations, and your taxes for this year of income on this property would be $794. That means that your net income after UDFI taxes is $11,206. So when you are considering this type of an example, what you want to do is maybe kind of do some estimates as to what your net income would actually be after taxes, because $11,206 might be worth it to do this investment and go through the borrowing funds. So just something to think about. Now, unrelated debt finance income is taxed, and it is reported to the IRS on Form 990-T. Again, it's taxable at the trust tax rate, and we recommend that you discuss this with your tax advisor so that you can be sure you understand how this operates. And we would, when this comes into play in your retirement account, we give you and your tax advisor all of the documentation to be able to fill out the 990-T. We can't fill that out for you. We can't do your taxes, but we can give you all the necessary information. All right, so that, oops, oh my goodness. I want to go back. There we go. We are going to have Q&A right now, but I do want to put up onto the screen how you can contact us. We do have a website that has a great deal of information there, including some information from clients and how we have helped them and the types of investments that they are doing or have done in their retirement accounts. That's stcira.com. Our corporate number is there on the screen for you. If you think of questions after we finish this webinar, please feel free to get in touch with me at my email, jknight@stcira.com. Now, I did get some questions in advance, so let me pull those up. Again, if you have a question that you would like to ask, please type it in the questions box. You can click the arrow next to questions and a drop-down box will appear and you can type in that for me. And let me pull up the questions that I had. All right. Okay, the first question that I had is, how do you take out of this account to pay yourself once you're 59 and a half? Okay, so like all retirement accounts, you can begin taking qualified distributions at age 59 and a half. So with STC, an account with STC, we have a form that you would use to request a distribution. That's what that would be, a distribution. You would be taking money out of your retirement plan. So you can get in touch. I don't know if a client asked this, but you can get in touch with our client services department if you're not familiar with that form and request a distribution form, and they can help you with that. Okay, let's see. I had somebody ask about precious metals here. Okay, so with STC, you can work with a precious metal broker and just send us the form, what you decide you want to purchase, and then we'll send the money to the broker, and the broker will send the precious metal to us, and we will store that in the bank. So we have safekeeping of that for you, and there's no charge for that safekeeping of your precious metal. There are a number of different types of metals that you can invest in: gold, silver, platinum, I think even palladium. We accept gold, silver, and platinum. Certain coins, if you need an exact description of types of coins or bullion that we can hold for you, I can email you a document, get that to you. But it's a very straightforward process to own precious metals. Basically, you place your order with a precious metal broker, dealer, and they'll give you an itemized invoice for what you're purchasing. You'll send that to us with your disbursement request, and then we will purchase that for you and hold the metal for you. Okay, let's see. I have some more questions. Oh, yes, this was a question. I mentioned earned income, making qualified contributions from earned income. So you do have to have earned income in order to make a distribution, or excuse me, a contribution into a retirement account. And earned income are these types of things: wages, salaries, tips, other taxable employee pay, long-term disability benefits received prior to minimum retirement age, net earnings from self-employment. So there are different types of earned income, but investment income is not earned income. So that does not qualify as a source for making a retirement account contribution. Okay, and I have a couple more questions here. Where'd they go? Okay, this is a question that's actually relating to a conversion to a Roth account. So let me just describe what that is before I answer the question. If, I told you that in a Roth account, your investments, as they're earning, those earnings, when taken as distributions that are qualified, are not included in your taxable income. So it's basically a tax-free earning opportunity. So there are folks who would like to convert maybe from a traditional IRA convert that into a Roth IRA so that they can begin, earning tax-free. So first off, know that if you do that, there is a tax due, because remember, your contributions into the traditional IRA were never taxed. So a Roth conversion will have a tax consequence. Now, this person is asking, how are taxes calculated on assets that are converted to a Roth account? So I'm assuming they're talking about, say, a piece of property. Cash is cash, so that's the value of it. Whatever the liquid cash is, that's what the taxes are calculated on. But if you are putting into a Roth account a property, then it would have to be appraised, and it would be the fair market value of that asset on the date of the conversion would be the tax, what would be taxed, and it's taxed at your ordinary tax rate, income tax rate. So it would have to have a valuation and appraisal done, and that market value is what would become the taxable value. Okay. I have money in my account that is idle from time to time for long but indefinite periods. I would like to earn a return by buying short-term instruments that will earn more than the bank interest rate. Options? Question mark. In other words, what are my possibilities? Well, if you want to keep it liquid, I would suggest maybe you open a brokerage account and invest in assets in your brokerage account. Now, this is a brokerage account that's owned by your retirement plan. So it will have some specific requirements that will need to be set up as a business type brokerage account. You can operate it, you can buy and sell in it, but you can't add money to it or take money out of it directly. That would all have to flow through us into the brokerage account. But inside of that brokerage account, you could invest in whatever you liked, and then when you found an investment that you wanted to purchase, you could just liquidate whatever assets you chose and move that money out of the brokerage account into your LLC, and then we could fund the investment for you. So that's a possibility, and then that's very liquid because you can decide to sell anytime. Tax liens are usually pretty short term, but again, they do have a time frame on them. So probably a brokerage account is your best bet. Can I invest in seed startup investing in my retirement account? I would be investing for an equity stake, partial ownership. Okay, as long as the entity that permits retirement account investors and the investment, doesn't violate any of those prohibited transaction rules, that should be a viable investment. Now, a couple of things to keep in mind. You can't work for this company. You can't, even for free. You can't do anything. All those prohibited parties, your spouse, your ascendants, your descendants, none of them can be involved in this either, because it's your retirement account that is investing. Depending on how your retirement account is earning from this business, it could trigger UBIT, unrelated business income tax. I didn't really define that. I talked about UDFI, which is a subset of that, but UBIT is unrelated business income tax. And basically, it's when an entity engages in a business and earns money that's not related to its direct purpose. So the IRS has determined that UBIT can apply to some investments in retirement accounts. Pretty rare, but just keep that in mind, that it possibly could trigger that. Okay, it looks like I've got time for just a couple more questions. If you have a rental property in your account, who does the renter send their check to? Okay, that really depends on whether or not you're using a property manager, which we do highly recommend, because that does, keep an arm's length distance between you and that rental property in your retirement account. So typically when the property manager collects the rent checks, the rent's made payable to them, and they take out their cut, and then they would forward the rest of the funds to us, payable to your IRA LLC. Now, if you're not using a property manager, then the checks would need to be made payable to the IRA LLC, never to you personally. And your renter could mail the check to you, but then you'd have to turn around and mail it to us. So you could have them send it directly to us. In either scenario, though, when we receive those funds, we will send you an email that they've been received and posted to your account. Okay, let's see how much time I have. Looking back to these questions. Okay, so this is one about a loan. We didn't really talk much about loans tonight, but but you certainly can make a loan from your retirement account to someone. And the question is, does STC choose the terms of my loan? And the answer is no. This is true self-direction, so you're going to choose the terms of any loans that you want your retirement account to make as investments. What we would do is we would make you aware of any of the terms that you're setting for this loan might raise a red flag in an IRS audit. You know, you want to keep in mind, this is one of the first things I talked about, prohibited transactions. Transactions need to be for the benefit of your retirement account. So if you were loaning funds to, say, your sister, who's not a disqualified person, you know, for 5 years at 1% interest rate, that's pretty low interest, and the IRS would wonder why you were doing that. You know, your sister couldn't get anywhere near that kind of rate borrowing money. So what we would do is we would tell you that you might want to consider making some changes so that it didn't raise any red flags. But you can go ahead and do it, and then the IRS would decide what they thought about it if they did an audit. So, okay, well, my time is up. Thank you so much for joining me this evening. I hope you will get in touch if you have any questions. Check out our website. We would love to help you get started with self-directed investing if you're interested in that. And I hope to see you on our next webinar next month. Thanks. Good night.